Welcome, latest Motley Fool Scoreboard. I'm Anand Chokkavelu. We've got longtime fools, Matt Frankel and Jason Hall, giving a 1 to 10 rating to FICO Score Disruptor, Upstart Holdings, ticker symbol UPST. Talk about the strength of Upstart's business first, including factors like industry and competition. A 10 is invincible. A 1 is hopeless. Matt's got a 6. Jason, you're at a 7.
Yeah, the reason I went a little bit lower is there's tremendous opportunity, and we're starting to see the seeds of Upstart's disruptive capability starting to sprout. But the biggest challenge is that Upstart doesn't control the pace of business on its platform. Lenders are in control of that for the most part.
Yeah, well, they can control it if they're willing to hold loans on their balance sheet, which is a no-no. They don't want to have too many loans on their balance sheet. So I give it a 6. This third-party dependence is certainly a negative factor, but for me, it was more about competition. We keep hearing about Upstart getting more and more partners, but there are so many personal lenders that don't use Upstart's model that have a lot of traction. And it's a very competitive space that Upstart already has a pretty decent share of. So really, they're going to need to capture share of new verticals that they're going into. Auto lending and home equity lines of credit are the two big ones right now. And they really need a robust lending market to be profitable. And as we saw, they went from a very profitable company when everyone was borrowing money to the complete opposite in 2022 and 2023.
And for those who don't know, lenders use Upstart's kind of system in lieu of a FICO score, or maybe in conjunction with. And the theory is, hey, there are more approvals, and those are lower risk approvals. That's the dream case. Did I miss something, Matt?
No, they do make some of their own loans. Right now, they have about $800 million of loans on their own balance sheet, which is down from over $1 billion a year ago. So they do make their own loans, but yeah, it's used by lenders to theoretically do a better job of underwriting loans than just using a FICO score.
Yeah, and the majority of the loans that they carry are not they're not specifically for investment gains, but as they're testing out different loan products and as they're making changes to the algo, they use those to measure the result before they roll those changes out.
Kind of like a restaurant franchisor having a few company-owned stores to experiment with, but it's a franchising model. Let's talk about management. A 10 is Warren Buffett. A 1 is Homer Simpson. Jason, both of you have 8s.
Yeah, I think the reason I gave a business that really struggled so much over the past few years an 8 is because after some initial missteps after going public, management was really quick to navigate and resize the business based on the environment while continuing to focus on getting in front of as many of the lending customers as they could to continue to expand their partnerships. And now as the appetite for some of that lending is starting to increase a little bit, it's starting to show up in the results of their business.
Yeah, Dave Gerard is a very highly invested founder CEO. There were 3 co-founders to this business. I believe only 2 of them are still involved today. But there are some things, like you kind of alluded to, that he could have done better in the 2020, 2021 growth at all costs mentality. But really, I would give him a 9 in terms of navigating the tough environment. So combine the early kind of questionable decisions with the past couple of years, and I would give him an 8 just overall, and just how well he's kind of navigated this business.
For financials, a 10 is a fortress. A 1 is yikes. Jason, both of you have 7s.
Yeah, let's start with the balance sheet because, again, before this last quarter that we saw, which was wonderful growth and projecting that to continue through this next year, total lending was down, revenue was down, losses increased. And the balance sheet itself, though, has really held up. If you look at the year over year, total assets are roughly flat. That's pretty impressive considering how they could have really just burned through a tremendous amount of cash. And then you bolt on that economic potential of its operating business starting to show. And this has gone from what I would have said a 5 6 or 8 months ago to a 7 for me now.
Yeah, a pretty strong balance sheet. I mentioned they do have a little over $800 million of loans on the balance sheet right now, but they have almost that much in cash. The loans on the balance sheet have gone down about $1.4 billion in debt, which most of which is convertible, which has pros and cons. Convertible debt's generally at a very low interest rate. I think theirs is like 1% interest or something silly like that. But it could potentially dilute investors over time. And we're seeing a lot of the stock-based compensation really dilute investors. The share count's up 8% over the last year. So it's getting better. So I would call it a 7 and improving, but I can't really give this more than a 7 right now.
But it's on probation from the share-based comp police.
It is. Right now it was 133 million in share-based comp last year, which is down significantly. So it's heading in the right direction. So the police are backing off of them.
All right, Matt, let's talk valuation now. How well will Upstart stock do over the next 5 years, and how safe is it? 10's a sure thing, 1's a lottery ticket.
I said 10 to 15%, but I'll put a big asterisk on that. I don't see any scenario over the next 5 years where Upstart just does okay. This is a very volatile stock, regardless of whether it's going well or going poorly for the company. Just look over the past 12 months. The stock's been as low as $20 a share and as high as $96 a share in a 12-month period when the business was generally doing pretty well. So a lot of volatility. Expect a big roller coaster ride over the long term. The secret sauce will be if Upstart can grow into those new verticals, which are both bigger lending markets than personal loans are. That will be what takes it to the next level. It could do 30% annualized gains if things go right, but it could be below 0 if they don't. So I kind of put in the middle with that and said 10 to 15%.
Yeah, directionally, I agree with Matt. I think there's still potential for a little bit more of a binary outcome where there's a pretty reasonable amount of risk of permanent losses if the platform as a tool for better origination doesn't deliver. I've moved my safety score up on this company over the past year, though, because that database of evidence is growing that their process works, that their algo works, that they deliver better outcomes with the loan products. So my safety score is a 6. I am very much leaning more towards that evidence backing up outsized returns, and I'm expecting 15+% returns over the next 5 year. But again, there's still, like Matt said, a chance that if it doesn't go well, it's going to go wrong.
Yeah, to Matt's point on the volatility. Oh, I mean, he said $20 to $96 over the last year. That feels like a tight range compared to where it was, during like 2021 and stuff like that. If you look at the 5-year returns, 20 to 400. Right.
And then back to 20.
And then I think it was back to like 13 at one point.
Yeah, right.
And now it's back to around 50. That's like about a double from 5 years ago, but it's been a wild ride. Let's talk about Top It. Matt, is there a company in this space that you like better than Upstart?
Yeah, this won't be a surprise to people who've listened to me on shows before. SoFi is probably my favorite in the space. It's not really a direct competitor in the sense that they don't have their own like underwriting method or anything like that. And SoFi actually partners with Upstart as part of its new third-party lending platform. It directs loan traffic to Upstart. But as far as in the personal loan space, I just like kind of their all-in-one ecosystem. I like they have very much higher credit standards than Upstart. Upstart's designed for people without, great credit. So especially in an economically uncertain time, I prefer SoFi's methods a lot to Upstart.
Now, the thing that's interesting, though, is that SoFi is becoming a little bit more of a competitor. You mentioned that third-party platform. They're trying to expand it. And Upstart isn't the only other lender that they're partnered with on that. So it is becoming more of a competitor. Now, I do think that within the spirit of thinking about pure play, focusing on lenders and platforms, Upstart is special and unique. And like I said, I think we're just beginning to see its ability to be a disruptor shine through. So it's my pick in this category, despite the fact that I love SoFi, but for different reasons as well.
Upstart's one I'm always kind of looking at, but like I've never bought. And it's what Matt said a bit, right? It's, SoFi directs the people that they don't want to lend money to over to Upstart. And Upstart's like, yeah, sure. Apparently it works, but I'm not, I want, by the time the track record comes out where I'm like, oh, okay, their method makes sense, it'll probably be too late for me. Be like 10 years from now. Thanks to Matt and to Jason. They've given Upstart a solid overall score of 7.2 out of 10, despite uncertainty about its business. I may have to look in further, all joking aside. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is Realty Income. Till then, Fool on.
when the stock was trading at like $400 and this guy went on CNBC to talk about how great the stock was doing and stuff like that. And then the host says, so what does Upstart do? And he starts freaking out because he doesn't know and starts doing the, I can't hear you. Google that video if you haven't already.